Hello, my name is David Hillier, and I am one of the authors of the book Fundamentals of Corporate Finance. I will be giving a series of small, bite-sized videos that will accompany the book Fundamentals of Corporate Finance. I will be going through each of the sections in turn, so each video will correspond to one section. I'm hoping to get it to 15 minutes, but in my past experience of doing videos like this, I tend to go to about 30 minutes or even 45 minutes. But I'm hoping that these videos will be of some value to you in your studying and trying to get some of the soft information accompanying the book, and also get some other insights that I've not been able to include in the book. The book is Fundamentals of Corporate Finance, and the co-authors, as you can see, are on the screen, and this is the second European edition that I will be giving lectures on, and the section that we're concentrating on for this video is Corporate Finance and the Financial Manager. That's section 1.1. So what are we going to talk about? Well, I'm going to give you an overview of corporate finance and also what the main player in this whole story does, and that is the financial manager. Give you an insight into the types of activities a financial manager may be expected to undertake. And as you'll find out through the course of the book, a financial manager's job is varied. It's got a lot of responsibility, and it focuses in a number of different areas in finance. So our learning objective for this lecture is to know what the different decisions are that a financial manager will undertake and where the financial manager sits in the overall structure of a company. So let's start off and ask the question, what is corporate finance? Corporate finance consists of three separate activities. The first one is investment. Now, what does investment mean? Well, if you think about a company and what a company does, it has to make decisions relating to what it does with its assets. And those assets should be expected to provide some value to the company and to the owners of the company. So corporate finance, first of all, focuses on the issue of which investments should you make. And in this book, we will show you a number of techniques that are used in industry that allows a company and allows the financial manager to choose between a number of investments and to choose the optimal investment. Now, once a company has decided where it will invest, it then has to look to see where it can get the money to fund the investment. And a company has a number of paths it can take. It can take its internal cash flows. That is cash flows that is generated from past activities. It can go out and give up some ownership of the company. We call that equity. Or it can borrow. And it can borrow from a bank. Or it can issue contracts or securities called bonds in the financial markets. Now, whereas investment and financing are long-term decisions, the blood that keeps the body alive or the company alive is cash. And a manager must ensure that the company has enough cash to run its operations. It must ensure that there's cash available to pay their staff. They must ensure that there's cash available to pay their creditors or those companies or individuals that are owed money. It must ensure that there's enough cash around to deal with any short-term inventory issues or any short-term requirements to buy goods or to pay different bodies. It must have cash to pay the government in the form of taxes. So liquidity keeps everything together. And these are the three main areas of corporate finance. This book, Fundamentals of Corporate Finance, will cover this in a lot of detail and will go into each of the three areas over the course of the next 20 or so chapters. So I've spoken about what a financial manager does. Let's look at the responsibilities of the financial manager. I would have to say that a financial manager's responsibilities will depend on the size of the company. If you have a very large company, then a financial manager may only focus on one aspect of the company's corporate finance activity. But if you've got a financial manager who is employed in a small company, then it's very likely that that individual will be making decisions in a range of areas. So let's look at these 5 different areas. Start off, we look at the 3 branches of corporate finance. That's investment, that's financing, and it's liquidity or short-term financial planning. The financial manager would be involved in all 3 of those. A financial manager will also have to ensure that the company's accounting system is up to scratch and is fit for purpose. The financial manager also has to consider the audit function of the firm. And the audit function is there to ensure that financial control is appropriate and it's been carried out efficiently. If you're to bring all of that together, what are we saying? A financial manager must ensure that the company is financially sound, that it's making the correct financial decisions, it's choosing the correct financing mix, and it is managing its cash appropriately. In sum, a financial manager must ensure the financial welfare of the firm. Now, where does a financial manager fit into an organisation? Now, what I've got here is, and this comes figure 1.1 from the textbook. As you can see here, this is quite a complex company. You've got the board of directors. The board of directors are in charge of leading the strategic direction of the company. And the board of directors consists of a chairperson, chairman, the chief executive officer. The chief executive officer is like the senior manager of the company. You'll have executive directors. Executive directors are involved in the day-to-day running of the company. And non-executive directors, and these are very experienced individuals who are not involved in the day-to-day running of the company, but they come in on a monthly basis to give advice and give their experience on the issues of the day facing the company. The chairman heads the board of directors, and the chairman is basically the individual who is responsible for ensuring that the voices of the shareholders, the owners, is heard in the board. Now, if we then focus down or tunnel down into who the executive directors are, the executive directors in this organisation chart consist of the chief marketing officer, the chief financial officer, and the chief operating officer. The marketing officer deals clearly with the marketing, chief operating officer deals with the operations of the company, and the chief financial officer focuses on financial management. Now, that could just be one individual, and if you look at underneath the chief financial officer and all the different individuals there, those roles could be combined into one person. But as the company gets bigger, as I've said earlier, they can be split. So you can split the chief financial officer into 2 areas. You've got the accounting function, that's the accountant, and that's the financial controller. Or you have the treasurer, which focuses on finance. And then you can tunnel down in there, and under the treasurer, you see that you've got financial planning, you've got investment, capital expenditures, you've got the cash manager who deals with liquidity, and you have the credit manager who ensures that any credit that's given out by the company is being carried out effectively and efficiently. When you look at the controller, and that's the accounting function, you see that controller deals with accounting. So you've got the tax, you've got cost accounting, and you've got the whole area of ensuring that data is being collated. So that's a simplified corporate organisation chart. In a later video, I'll go into this in detail for chapter 2, and we'll look at a board structure, an actual board structure of a company. So So let's summarise. First of all, we'll look at investment. And investment, another name for investment is capital budgeting. Capital budgeting is covered in great detail in this book. It involves making decisions on potential investments that the company must make. Now, effectively, those investments have to create value, and the financial manager's job is to choose those investments that create the most value. Now, when we talk about value, we don't just talk about increasing cash flow, and that's all you're thinking about. You actually have to think about other things as well, such as, when are you going to get the cash? We have a timing issue in finance that is central to all of finance decisions, and that is that money that you receive today will be worth more than the same amount of money that you receive in the future, and we call that the time value of money. I won't spend a lot of time on this in this lecture, but it is something that I will spend a lot of time in a future video. The next thing is the financing decision, and we call that capital structure. And capital structure consists of the mix between debt and equity, borrowing and ownership. Companies like to think of a target capital structure, and that target capital structure is a function of a number of different factors, such as, for example, the level of assets that are tangible assets that are in the company. The decisions that a financial manager would make in this area would be, for example, how much should the company borrow? If you borrow too much, you become financially risky and you put the company's whole future in jeopardy. You also have to think about, okay, what's the cheapest source of financing? Why would you go for a more expensive source of financing to fund your investments when cheaper options are available? The financial manager must know the process that must follow to get that money, and will deal with setting up the whole structures of new financing, whether that's debt or whether that's equity. And then we go to the final one, which is the liquidity issue, and that's known as short-term financial planning or working capital management. What you're basically doing as a financial manager in this area is ensuring that there's enough cash available for the company. So, questions that they need to ask is, how much inventory should you keep? Should you have large stocks of inventory so that you're able to sell goods should there be a spike in demand, or should you try and keep inventory as low as possible to ensure you've got enough cash on hand? Should you sell on credit? Should you give effective loans to your customers, and what terms should that credit be based on? Who will you lend to? And if necessary, where do you go to get the short-term financing? Towards the end of the book, we'll be covering these areas in detail. So that's a very quick summary of corporate finance and what a financial manager does. It's descriptive in nature. As we go through the lectures, we'll spend a lot more time on calculations, real examples. I'll be using the web, I'll be using spreadsheets. If you want to get more online material, then you should visit the website for fundamentals, and I'll be putting quite a lot of stuff up there that will allow you and give you that support to excel in this area. So thank you very